Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. Today's programme has an industrial metal theme. Don't worry, it's not the music soundtrack, but the subject matter. We're exploring the metals markets and hearing why copper, in particular, could be the weapon of choice for smart investors with a longer-term view. As well as supply and demand issues, we'll be discussing the impact of tariff-induced volatility on the landscape too. Here to make sense of all of this for us, it's a pleasure to welcome back to the show Dominic Schnider, who looks after commodities and currencies in the CIO of UBS Global Wealth Management. Dominic, welcome. Always great to chat to you. And lots of recent headlines about copper. Of course, this flows partly because of the narrative around tariffs. But before that, let's take a step back and look at the base metals market more broadly. Give us a quick kind of sector-wide overview, Dominic, of where we've got to this year. Industrial metal prices up kind of mid-single digits, but just give us a bit of a snapshot of where we are at the moment.
Well, I think if you look at base metals, I think they held up reasonably well. If you think about all the uncertainty that we have with regards to global developments, particularly on the tariff side. So I would say just for the first glance, a lot of stability. That was really driven by a backdrop of strength in copper prices, but also aluminum prices have done reasonably well, and both of them account for roughly 75%. Thereabout of a broader sector indices. So I think they added to stability. Not all metals were blessed with such a price trajectory. We have seen weakness on the zinc side, for example, but also nickel, where there is plenty of metal around, has been basically under pressure, and the same also when it comes to lead. So a really, I would say, divided market at this point in time so far this year. Now, another way to look at the metals is maybe less positive, because if you think about it, the dollar has come down quite a fair bit, that actually in euro terms or other currency terms, actually the metals have been weak. So what might seem to be stability, I would say at second glance, shows element of softness.
Yeah, and that dollar weakness is important. And just, I guess, on that kind of aspect, Dominic, let me ask you this. Where we see broader kind of macro concerns of the type that we're seeing, into the second half, and if we look ahead into the fourth quarter, how sort of directly does that shape or reshape the metals landscape? Or do the two things kind of sometimes sit sort of separately from one another?
Well, historically, if you look at just dynamics and some of these manufacturing PMIs, they are quite important for where prices are actually going when it comes to industrial metals here. Clearly, what we are looking out for, what's the damage basically due to all these tariff uncertainty that we have witnessed? I think that is still to be assessed. I think that's a big question mark. So if you obviously are in the very bearish camp that manufacturing is negatively affected, then your stance must be on one of weakness, I would say, across the entire industrial metal complex. If you think there is going to be a deal, and the reality is that there are different ways to circumvent the situation, plus there are commodity-specific factors out there that favor higher prices, then you might have a view that, stability, that's your narrative in the third quarter. And then I think forward looking, I think everybody thinks about, okay, once we're through that tariff uncertainty, we have some form of clarity. We've seen rate cuts across the globe. If the Fed also starts to join that kind of camp, maybe not so quickly, but at some point, then there should be some form of manufacturing recovery kicking in 2026. And that would mean the entire complex can really move higher, meaning, for example, copper prices then marching north of $10,000 a ton.
Well, yeah, and indeed, you kind of alluded there, Dominic, to some of the sort of reasons to be cheerful, if you like. And just look at that over the next 12 months, still pretty positive, particularly, as you say, about copper. Why so? Let's talk more about copper specifically. Why is that? It's not an outlier, but why is that potentially positive over that slightly longer time horizon in your view?
So I think the first one is we need to understand that market is potentially this year in a market deficit, but also next year there could be a shortfall of copper on a global basis. And the reason is very simple. First of all, getting copper out of the ground is difficult. While we always get quite nice indications from companies how much copper they want to produce, but the bottom line is when we then look at mine supply growth, it's barely growing 1 or 2%. So all the difficulties to get copper out of the ground is one key factor. It's not like other metals where there is now abundance available, for example, like in nickel at this point in time. So we need to understand that part. So supply availability is at this point in time constrained. The other part is we all want to go away from fossil fuel, have a greener environment, and I think that still gives us a very decent demand backdrop when it comes basically to copper. So we're looking, for example, this year around 3% demand growth in an environment which is obviously manufacturing has been shaken. So we have that kind of strong demand, secular demand trend, which is supporting the metal. Important here to recognize when it comes to the demand side, do we separate things a little bit? China is the most important driver of copper consumption. More than around 55 and more % of global demand is linked to it. Some of it is obviously exported to some of the goods that basically China is exporting. And we have solid Chinese export. That is one thing. But we also have seen domestically solid demand when it comes from the Chinese side due to various reasons. Let's say grid investment, for example, and other parts of the manufacturing landscape. So I think that has been a beacon of stability for copper. You see that also reflected in I would say, some of these treatment charges, which has been very, very low for some of these refiners, almost making it impossible to make money at this point in time.
Let's talk a little bit about the US and some of this kind of, I guess, primarily tariff-induced recent volatility. And we've seen, in terms of, you were talking about supply and demand there, we've seen some front-loading, of course, haven't we, ahead of US tariff announcement. That's maybe supported consumption. But talk about the tariffs next for us, Dominic. I mean, what are we seeing and why are we seeing it?
So, I mean, maybe to start with, the US is an important copper consumer, but it's not the most important. So we're talking here 1.8 million tons of consumption in a market that maybe has the size of 27, 28 million tons. So it gives you a little bit of a reflection that obviously the US is an important but not the important driver. Now, what happened is obviously with Trump coming in, looking to put on tariffs when it comes to imports of copper, and the US still needs to import roughly half, depending on how you calculate it, a little bit more than that one, of its copper consumption. It needs to be imported. And he said, look, we're going to slap tariffs on potentially. Now we're looking at potentially up to 50% tariffs. And that had massive impact. How was that possible? Well, very simple. While the market was looking for tariff, prices in the US started to rise quite dramatically. And that pulled in a lot of metals. So the US already imported a huge chunk of its annual demand already so far this year. And so I think you saw that factor due to higher prices in the US hoovering up all the metals around the world. We see that reflected in inventories, at exchanges going up rapidly in the US at COMEX. And that clearly tightened the market artificially, I would say, but it was nevertheless some form of tightness. Now, what we see lately is that he said, you know what, these tariffs potentially is going to come into place on the 1st of August. So that window of importing is now shut. What does it mean? Well, it meant that this effect, this vacuum effect, due to tariffs is now going into a little bit reverse to some degree, meaning there's no more shipments going to the US, so things are coming down. And that meant also, for example, that prices at LME started to fall off the boil compared to some of the rallies that we have seen just 1 or 2 months ago. On the other hand, the spread between US prices in copper and LME and the rest of the world has widened quite significantly, even further, because obviously the threat of 50% tariffs suggests that longer term we might even face higher prices in the US due to this tariff announcements. So a reverse effect lately due to all these policy changes that we hear out of the US.
Well, yeah, and just on the sort of domestic US picture, and it's funny, I was chatting to your colleague Paul Donovan on this programme, I think just in the last couple of weeks, Dominic, and we were talking a little bit about, prospective 50% tariffs, etc., and talking about, what the actual domestic impact of that is. How many basis points does that move up consumer price inflation, for example, and where does that leave US prices ending up compared to global prices? And it is worth kind of underscoring the point that despite the noise around tariffs, sometimes the impact of those measures can be quite different, certainly for domestic market and domestic consumers.
Well, absolutely. I mean, if you look in terms of aggregation, obviously copper doesn't really play a big role. If you just think about what I just said, the US consumes, let's say, apparent demand 1.8 million tons of copper on an annual basis. If you translate into what that means as a share of GDP, then the number really comes in very, very low, so almost insignificant on an overall aggregation. But yeah, obviously, if you're a consumer of copper rod, for example, or copper is 10-20% of your cost base. If you produce certain items, then things do look different. That's where you're going to see a fair bit of inflation. So I think we need to a little bit differentiate. Aggregated on a global economy, as in the US economy context, probably not that much of an impact, but there can be quite a fair bit of distortions or shifts up in prices on an individual level where copper is the main driver of goods. So let's keep that in mind. And even if it's a 10% move, if you see prices go up 50%, that still means that your end product potentially, depending on how you can pass on the cost, can go up by 5%. So there you will see the impact. I think that's quite certain. On the other side, initially we were thinking about demand continue to grow in the US because we have that structural case, this phenomenal case on copper. We want to have clean energy, and it's part of that energy transition. We were looking at demand heading towards 1.9 million tons. That's a little bit of a question mark. Is substitution going to kick in, and to what degree? As obviously consumer in the US look for cheaper options elsewhere where it can be actually substituted.
Dominic, just finally, talk to me about the ongoing opportunity then. We've alluded to this already, but, we often say, what does this mean in terms of the nuts and bolts of advice to investors? Talk a little bit about your conviction that, selling the downside price risks remains, attractive. Given all this volatility, there are opportunities there. Just give us some shape of what that opportunity actually looks like.
So from our side, I think there are two opportunities that we like at this point in time. I mentioned before, we still have that growth uncertainty on the manufacturing due to tariffs. I think that still means the prices could come down. So we have a forecast short-term $9,250 a ton when it comes to LME. So shouldn't really rocket away. But we know that structural case, I mentioned this market could be in a deficit this year and next year. It's not a huge one, but probably we're talking here 100,000 tons and thereabout. And I think with that structural case and the cost challenges, you should see higher prices. I think in that environment, we like to sell volatility. Now, vol in copper is not particularly high. It moved up a little bit, but I think the case that we have here is to take the downside risk, get rewarded with some kind of premium by the market is something that we like. That's somebody who has the mindset that in case copper would come down, that basically start to position yourself for higher prices. And if it's not happening, you get handsomely rewarded by a premium in the market. That obviously depends on everybody's preferences. I think we like 300-400 basis points, something to think about. And I think what I also think in terms of tenor, that can obviously vary given the trajectory and the outlook. I think from that perspective, we also see that at some point the difficult situation with regard to tariffs should be over. There will be some trade deals, and I think then the market will look more towards the recovery. And I think that's then the narrative for the next year story, where we look at copper going to $10,750 a ton. And I think in that environment, we like to be long copper. So I think for somebody who has that longer term mindset, wants to be positioned towards that structural factors, potentially also having a cyclical lift, I think copper is known to track such cyclical recovery the next year a little bit more firmly. So two opportunities that we like here, one more long term, and for those who want to be a little bit more on the defensive side, but also understand that there's a limit where prices can go to the downside.
Dominic Schnider there, bringing us to the end of this edition of the programme here on Monocle Radio. You can listen again and explore more at monocle.com, or discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS. I'm Tom Edwards. Thanks for listening.